Hi, everyone, and welcome back to another show. My name is Tyler, and I'm here with Matt, the founder of ORATS. ORATS is an options analytics platform built on top of over 15 years of historical options data, and our dashboard is integrated with Tradier, meaning you can research and discover trades on our platform and then seamlessly send them through to your Tradier brokerage account. Today on the show, we're going to discuss how to calculate macro event volatility from the options market and review an article that Matt wrote recently on the topic. Matt, do we have any positions to review this week?
Yes, and I could go to the trade journal and find them a lot easier than before. So our trade journal is in beta. So if you'd like to join, just email support@ORATS, ask to join the beta. It's for paper trading only right now. So I could go to the trade journal. I could go to the last 14 days. I could go to all. I could go to whatever. I'm going to go the last 14 days and sort by entry. It was the 18th the last time we had it. So this shows us up, but the market's down today, so we're losing a little bit on that. But that's the trade that we got into. Yeah, so today I'm excited. This is a new analysis. I'll show you the reason why we've done this analysis. So I'll go to our options chain, and what we see is you could see that there are bumps in this. Like so, the gray represents the at the money. So that's one way to look at it. You could also go to our trade builder and see these bumps right here, Tyler. Like you could tell that it's a little bit choppy. So
yeah, we also have in the Outlook a IV term structure graph that shows it a little bit clearer.
Okay, yeah, that's another. You're right. That's another place.
Lots of ways to look at the term structure of volatility at ORATS.
Yeah. So what you'll notice, and especially with all of the 0DT1, etc., the weekly expirations, is that the IV. So this isn't that. This is the term structure here. So you see how choppy that is. So the goal, it should be a rational term structure in order for arbitrage and that to hold. However, what happens is you'll get two things affect these. It's weekends and holidays, the way you account for those, and also if there are any events coming up on the day when traders will generally add some volatility. It's much like an earnings event where the implied volatility goes up, and then after the big move on earnings, the volatility drops. So this is a similar type of thing that happens, and the goal of our analysis, which I'm doing kind of in an alpha mode, is to smooth out that term structure and present a better way to deal with weekends, and B, how to find and summarize the bumps that are often associated with macroeconomic releases. Does that make sense so far, Tyler?
Yeah, it does. I just want to step back a little bit and maybe have you explain, like, because I'm curious as well, like why make a rational term structure? And that's question number one. And question number two is, don't we do this already for stocks with earnings? So how does that all kind of relate to the macro event structure here?
Right. So I would liken it more to our borrow assumption. I'm going to answer your question, but I think it might help with that analogy. So if you get call and put implied volatilities that are different from one another, and your question is why get rational? Well, the rational thing is it should never in volatility assumptions, Black-Scholes, etc. That should never happen. You should never have premium that is valued differently on calls and puts. And so what we do is we say, well, the only reason that they'd be different is for kind of interest rate reasons. So interest rate meaning any rates like dividends, borrow rates, or the assumed interest rate level. And so we solve for that interest rate using residual yield, and then we try to identify the amount that should be in borrow, and we line up the call and put implied volatilities. So that's a rational thing to do to do that. Now, your question is, well, why have a rational skew of the term structure? Why it's just the term structure? Well, the Black-Scholes formula is just a model, and that model should, if it's bumpy, or especially if it's bumpy consistently, it's hard to make decisions based on that bump. Because if you are saying, well, Friday has 5 days to expiration, and then Monday has 8 days to expiration, that implied volatility on Monday is going to be much lower. You're going to be buying Monday, when that's not really a rational thing to do. You want to see what the true effect of the weekend is, both from a historical and an implied volatility, and try to smooth that out. So does that make sense so far for why you'd want to make a rational skew that way?
It does, and it reminds me of a lot of questions that we've gotten over the years. We have a lot of people coming to us, and a lot of people, I think, don't realize there is no standard volatility number. Like, there's no volatility number reported by the exchanges or anything like that. Like, it's a calculation, right? And I think that's important to know, because you see graphs like the IV term structure we're showing here, and a lot of people might say, "Oh, that looks normal," right? Like, that's what it should look like. But in fact, it's all just a calculation, and kind of what we're saying, or is what I'm hearing from you, is that we want to make the most rational calculation so that you can make the best decisions given the data.
Yeah, very well said. And so that's the way you want to think about it, right? So when and that's what ORATS does. What I think we do better than most is, the first thing you have to do is find a very good at the money volatility. We haven't really talked about that. And that is found using this kind of smoothing of the monthly or the expiration strike by strike, and strike by strike skew. And so I'll just flip to that real quick again in our chain. So you could see like the purple and cayenne for call, purple for put, pretty clever. And you could see that there's a if you click on it, it's hard to see with SPY or with SPX, but there is a line behind that, and we draw that line through the weighted average of all the implieds, and then at the 50 delta we report that as the at the money. So that's the first step. That's difficult to do. It's actually one of the hardest things that I've done. It seems easy, but it's not. And then once you get that at the money vol, then you line up the term structures of each expiration, and then you go from there, and then you try to figure out, okay, what is going on? Why are there bumps? Okay, there's a weekend bump. So we have in our, we're a publicly facing firm that puts our research out there, and so we want things as standard and as easy as possible to understand. So we use calendar days to expiration as our default. There are other people that use business days to expiration, but both of these are showing different, still there's still going to be bumps in the business days. And so what you want to do is figure out what the actual days to expiration. So instead of Friday being 5 days out and Monday being 8 days out, it ends up being something like Friday is 5 days out, since there aren't any weekends there. And however we do, depends on what time you look at it as well. So we do have a way to decay away the implied volatility throughout the day. but the Monday is the big problem. It's not 8, it ends up being more like 6 point something days. So it's not quite business days, which is 6. It's closer to like 7 probably.
So just to clarify, I mean, obviously it's a fixed number of business days away, but you're saying in reality, in terms of what the options market shows, is that if you derive a bunch of meaning from the options market, you can say, oh, the options market actually thinks it's 6.5 days away because of what we call the weekend effect. And so that's why we can sort of make that claim that it's 6.5.
Yeah, so you're right. There's a rational amount of business days into that. There's also a rational amount of calendar days, but the Black-Scholes formula takes the option prices and then creates an implied volatility. Now, if there are more days, that implies volatility is going to be lower than the Friday. So let's just say it should be over history, it should be somewhat equal to Friday. It should be between Friday and Tuesday, the Monday should be for the implied volatility. And so anyway, we have a way, or I've developed a way to figure what that actual amount is. And so that's the first step, is then to get, so you have, it's not business days, it's not calendar days, it's what I call the weekend and holiday effect process, WAP, W-H-A-P. So you first WAP it, and then you still have choppiness in the term structure. And that choppiness has to do with, now you can try to figure out what that choppiness is and where that choppiness is coming from. And it's at that point we could come to like a graph that we put together for this particular report that we've done when we did this.
Yeah, I wouldn't say it went viral on Reddit, but it definitely got a lot of likes.
Yeah, it's like 30,000 views and 71. That's the most I've seen on something in a while. So that's kind of nice that people are paying attention to it. So yeah, I'd like to talk about this chart right here. So this is what we see. So this is the actual volatility here, right? And you can
we maybe zoom in a little bit, Matt, on that picture?
Yeah. So let me try to do that.
Yeah, that's better.
Okay. So this is the blue line is the actual. Well, and that's the actual with the WAP taken out of it. So that's so that this is as rational you can get without doing that kind of earnings effect analysis that we do, or in this case, I call it the IMM. Implied macro move.
It does look very similar to how a stock chart looks with the earnings effect. You sort of see that big jump on a certain week,
right? And
but
so
that's for SPX, right?
Yeah, this is SPX. So what you want to do is you want to say, well, this should look like this. So this red base volatility is a rational, or at least more rational. You can see a little bit of a tick here, and perhaps a little bit more of a tick there. But this is kind of like as smooth as we could get it to make a rational term structure. You can see it's in backwardation. Backwardation is when the front month is above the back months, but that's because of all the recent volatility in the market. So that's pretty rational to see that. But what we want to take out are the bumps. So that's the more difficult part. And ORATS has a kind of earnings extrication process that we can then say, we take this out. What is the additional move? So it's 1.56 times whatever the base volatility is the amount that we will then take out, and then we make a rational skew. And then what you want to do is you might say, well, that's not when you trade, you're not going to get this red, you're going to get the volatility that's implied here. And that's true. But now you're not really analyzing the volatility. You're analyzing what I think is the base volatility. But then you could, like we do in earnings, and we analyze earnings effects. Like Nvidia it has an 8% earnings effect, and we can look at that, and that's pretty consistent over time. When we look at this 56% on the 27th, there are things like initial jobless claims, the GDP, durable goods, the things that we list here that are coming out, and that's why. Also, I should say Nvidia's earnings is coming out on the 26th, so that's adding to it as well. But that's why it's higher there. So what you want to do is you want to say, okay, if I'm making a trading decision, especially doing a calendar or just an absolute trading decision, I want to look at implied volatility on its own, its base effect, and then I want to say, then I want to analyze separately what the additional volatility is that traders are putting into the market, and then I could say, well, that's probably based on these types of macro events, right? Do you get where I'm going with this, Tyler?
Yeah, it sounds, if you guys have watched our previous shows, you might say it sounds a little bit like our forecast edge, right? Like we're sort of making a comparison to the market price based on a certain number of factors. Would that be a right comparison, Matt?
Yeah, that's a good comparison. We're not forecasting volatility, so that's where the analogy falls. But we do have in our forecast, we do have a forecast of earnings, and so that forecast of earnings is kind of what we're talking about here. So what you could do then is you could trade around the valuation of not earnings, but of these macro events.
Right.
So that's essentially what we're doing. Does that make sense?
Yeah, I mean, it's very interesting. I haven't really seen this done, I guess, in such a robust manner, and I think it's great that we're doing this. Also, just so that everyone knows, this is not like currently a process that is applied to the IV for SPX. This is something that Matt's done recently, and I don't know, Matt. I mean, what do you think about including this in ORATS indicators later? I mean, it sounds like people are really taking kindly to this approach.
Well, yeah, I mean, definitely we're going to have this. And there's a few other things. This is kind of a proof of concept to get it out to people and judge the interest. So if you would comment below if this is important to you, it's great to let us know. So so far you're with me, right? So we come up with a weekend and holiday effect. We take that out. It's still not smooth. So we go in and we find the big bumps in there, and then we associate those with macro events. So when you're trading, then you are comparing what the percentage additional volatility is to the macro moves. So then you might say, well, how do I value that? Like in Nvidia, we could go in and we could look at past earnings, and we could say, well, right now it's implied at 9.5. It's usually implied at 8.2, and it only moves on average at 7.6. So that's probably an expensive earnings amount for Nvidia. So do you see where I'm going with this, Tyler? Like, so
Yeah.
all these vols in Nvidia might be a little bit overdone. If you look at historical earnings moves alone.
Yeah.
So I think the next step is to say, well, what on average are these macro events implying from an additional volatility perspective?
Right, and I think a big reason why this is important, it's not just for sort of, I guess, what you could call like arbitrage around the extra IV from these macro events, but also deriving a smoothed sort of volatility curve that you see here is really important for analyzing SPX historically versus itself, so that you can apply better signals to strategies. And that's something that we're working on right now, Matt. But I think that's a big reason why it's important for like X earnings too, is like, well, why develop an X earnings implied volatility? It's because you want a better way to compare, in this case, SPX with the X macro events. You want a better way to compare SPX now to SPX 3 years ago, or to other ETFs and stuff like that.
Right. So it's like NVIDIA, is a good example. So the volatility, as most people know, goes up, 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 and then crashes down, up, 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 crashes down, up, up, crashes down. So if you want to know what the earnings is, like, it depends how close to earnings, the earnings date it is, just by the effect of, the 1-day volatility versus, how close it is to happening. So that's difficult to do. But if you say what's the average implied volatility for NVIDIA, well, it depends where you are in the cycle, which is kind of a bad answer. What you really want to do is you want to do the X earnings implied volatility for NVIDIA. And if you do that, what you'll see is a less volatile, it's still volatile, but the volatility here, it's coming outside of earnings time, and it's a lot, more, I would say, it's a lot closer to what like a volatility should be in a particular asset that didn't have quarterly 1-day jumps that are expected like earnings are. So you can see that, like, earnings are low or high, and you could then isolate the earnings effect, like we did earlier, saying that the 9.5% that's implied right now is probably high from a perspective of a historical perspective of actual moves and implied moves. So I'm mentioning that because I think you do the same thing for these macro events. And so one of the things that we've done, Tyler, and you were kind enough to get this and parse it out for me. So you gave me all of the macro events, and I studied them back to 2023, and what the average, and then deduced based on these types of analysis, what were the average moves associated with each one of these bigger macro events. Are you clear on that so far?
Yeah, I really liked what you said earlier about how a big part of what we're doing is just getting to the true implied volatility of the underlying asset, right? And like, a lot of people are familiar with the IV crush that happens after earnings, and the rise of IV leading up to earnings. But I don't think a lot of people are familiar with this particular example with the macro event. So I think it's great that we're bringing this to people's attention, and that soon we'll be able to offer a calculation that can help a lot of people out in developing their strategies better.
Right. So, we'd in effect have an X macro event volatility for SPX, and then be able to talk about what the implied additional moves are. And so people could then, look at these historically and come up with some type of a strategy based on that. So, for example, so we see these macro moves on these certain days. And so what we've done, by the way, this is our calendar. It's kind of cool to see this graphically at what time it comes out. This is in the ORATS dashboard. But so what we're saying is, over the weekend, we said February 27th has a high implied volatility. And that's just, we thought that there are, several significant things coming that day. There wasn't really anything on the 24th. That was yesterday. That was just a continuation of market volatility. But what we've done is we've said things like, let me see where I said these things. I didn't put it in here. Yeah, so unfortunately, did I not put this in here? Yeah. So in this article, I don't see it, but what we've done is we've gone through and we've said, GDP, the price index has, a certain additional volatility associated with it. The initial jobless claims has a numbers associated with that you could then either average and compare or whatever with that. So we'll be adding these kind of analysis of the actual moves, much like we do for earnings. So you could then compare this 56. You could compare this 106. This is a big move for non-farms on the 7th. So I mean, there's some big moves, and these change a fair amount. These aren't that steady. Throughout the day you'll see it changing, and as new information comes in, those will change. So this is a pretty big deal, I think, going forward for. Especially, there's so many more short-dated option traders, and this means a lot more for them. So this is kind of why we're coming to releasing this type of information, Tyler.
Yeah, I think it's fantastic. I mean, I think it's something very unique, and definitely follows our a lot of what we do, which is just giving you the smoothest and best volatility surface that you can perform analysis on and get some signals for your strategies in a lot more I guess honest way. Like it's really hard to derive good signals from data that isn't smoothed like this, right? I mean, because the
Because
option market.
you have to isolate earnings on its own, and it makes it much more rational to like take the earnings out. In this case, we're taking economic events out, and then what you could do is compare that to economic events historically, and then so that's what you're actually, when you're trading that month, you're essentially trading the standard base volatility, and you're trading that additional volatility too. And again, if people are interested in this, we'll take the analysis farther, including even like down here, we're showing exact times that these things are announced, and so you could see where the volatility goes during the day after these, and you could then imply those. So that's going to be really exciting to kind of get more granular, and which makes more sense with the zero DTE trading. So when a economic event is announced at 10 a.m., it'll be implied volatility before, and we will have ways to calculate where we think the volatility should fall to. So that's outstanding information to have, that you could then come up with trading strategies around this types of data that's very difficult to come by.
Yeah, it's very exciting where we're going, not just with this, but with intraday, like you said. So yeah, very excited for that too.
I don't really have a trade for today, Tyler. That would involve updating this, and we don't really have it. But perhaps in a future show we'll have the ability to update it faster, and then and show you what types of trades to do around them. With like, so for example, over, if you could have done this Friday, you might have sold this month, or it depends. Like, this looks actually cheap. Whereas this 106 could have been expensive for non-farm. So you might have purchased the 6th and sold the 7th, or, something like bought the 11th and sold it. You could do a calendar, or if you have to do a reverse calendar, brokerages don't give you much relief unless you're in a portfolio margined account. But you'd have to do something like, buy a butterfly, sell a butterfly, do in order to come up with a strategy that's a short calendar. There are ways to do that, but it's a little bit more difficult. Buy an iron condor, sell an iron condor is probably the better way to do that. But a butterfly is kind of like a iron butterfly anyway. So those are those are ways that you could do. Maybe we'll do that on an upcoming show, Tyler.
Yeah, sounds good. Yeah, and that just made me realize how important it is to have this in an indicator so that we can actually use that indicator and have it in a number. And we have hundreds of other indicators, so go check them out already on ORATS.com.
Yeah, definitely. This is just another one, but it's more geared towards, we wanted to up our game and have some alpha in the shorter term. And then once we do that, we'll have more back testing. We'll have other ways to check out how to profit from the knowledge that we're putting out here.
Excellent. Yeah. Nice job, Matt. Great presentation and great article. If you guys want to learn more, we have this article posted on our blog, so you guys can read it on ORATS.com. If you guys have any questions, just leave a comment in the video, or you can email us at support@orats.com. We'll be back again next Tuesday. Thank you, Matt, and thank you, Tradier, for hosting us again.
Thanks, Tyler.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.